Looking back at my 6 years in the market, I've made some really dumb mistakes, like going all in into a single stock. Yeah, imagine watching your entire portfolio crash just because you were too confident in your picks or thinking that you could always time the market perfectly. So today, let's talk about my biggest investing mistakes and how you can avoid them. Back when I started investing, I thought I was the next Warren Buffett in the making. So why bother with index funds when I can pick the next Apple, right? Here's the thing. Whether you love stock picking or not, putting even 10% of your portfolio into a broad-based ETF like the S&P 500 or the Nasdaq 100 is one of the smartest thing you can do. Yes, this is coming from someone that loves to look into companies and build his own portfolio. So two reasons. First, it's your safety net. So if your brilliant stock picks turn out to be not so brilliant, at least you've got a base layer that continues compounding out into the future. It's like an insurance policy for your investing ego, of course. Sure enough, if you don't turn out to be as brilliant as you thought, you just have to delay and extend your retirement, maybe by a few more years. But at least you don't have to start from scratch. On a side note, I don't think the active part of the portfolio will go to zero anyway, unless you are picking turnaround companies that is on the brink of bankruptcy. So that's that. Second, it keeps you honest. So if you were to adopt a dollar cost averaging approach to buying into an index fund like the S&P, it helps you keep a running score. So a running score also means that it can form some sort of a check and balance to your ambitions of wanting to beat the standard index. So when you've got your own picks and an index fund running side by side, you get to compare. Are you actually beating the market or are you just tricking yourself? And specifically, I think it gives you a much more accurate representation when trying to benchmark your own personal performance or results. So I believe a large part of you, audiences on YouTube talking about investing or searching about investing research, are mostly adults with a full or even part-time income. And you guys will be allocating a portion of it to this whole investing endeavor. So therefore, by concurrently running both portfolios, we are basically trying to recreate this so-called avatar portfolio that invests alongside you, setting up a regular savings plan every month, buying the S&P at a fixed date while you allocate the rest of your money to your own research and stock picks, while also controlling the timing aspect of the investment. And by doing so, in retrospect, when you want to do a fair comparison in terms of capital inflow, it gives you a much more relevant benchmark to an actual index return rather than the chart that you pull out with no specific context. So to share my own journey, even though I started investing 6 years ago, I only started this indexing thing in 2022. And let's not forget, I also stopped my DCA at some point in time because, emotions, and sometimes I just forget to log in and execute the trade. So here's the tip. Set it up, automate it, and forget about it. Unless you really need the cash flow for something else, which is exactly the point of setting up this other indexing portfolio, unique for your own circumstances. And on that note, for those of you looking for a broker that provides you with a regular savings plan solution, Mumu is one that I'm personally using too. So one thing I like about Mumu is the RSP calculator function. It helps me estimate and backtest different regular investment strategies and can easily calculate the potential return for different amounts and also time periods. Also, if you link the RSP function to your bank card, Mumu will automatically help you exchange to the currency before purchasing it. On top of that, new users to Mumu can get welcome rewards worth up to 820 Singapore dollars. More about that later. And have you ever wondered what would your investment look like if you committed to a recurring investment 3 years ago? For example, putting in $50 per week in an ETF tracking the S&P 500 from Feb of 2022 until today, 3 years later, and your portfolio size grows to over $10,000. So with a rate of return of more than 30%. Now, Mumu's current promo will last until the 12th of May 2025, where new users who deposits a cumulative amount of at least 3,000 Singapore dollars can get $40 worth of Tesla fractional shares plus $30 worth of trading cash coupon. At the highest tier, you can enjoy $450 worth of Tesla shares and $370 worth of trading cash coupon. Furthermore, if you sign up with my link below, you'll get a $20 cash coupon exclusive reward. You get lifetime commission-free US stock trading too. Link is in the description below. And once again, thank you Mumu for sponsoring this video. Now, moving on to the second mistake, it's really the appreciation of the role of diversification and not be too caught up in your own arrogance or research. Essentially, it's the "I'm so smart, I don't need diversification" phase. Look, I get it. If you've done tons of research and have crazy conviction in a stock, why waste time buying your fifth or even sixth best idea, right? You waste time and you waste your capital. Some are even so confident to put all their eggs into one basket and go all in into one stock. So yours truly included, where I put 100% of my capital into just one name. And that was my all-in moment. Heck, I even know of some investors that go on leverage or even margin just to prove their conviction. So just a few things to take note here. Firstly, of course, please don't go into margin. I think the timing element in the investing world is the real killer. So as the saying goes, markets can stay irrational longer than you can stay solvent. So even at the end of the day, you might be right, but the market could go so much lower than you can imagine. So it can push you down to force a margin call and wipe out your capital base as you need to realize losses due to the leverage position. And as they say, the 3 L's that will kill guys: ladies, liquor, and leverage. And as Warren Buffett puts it, don't risk what you have and need in order to pursue what you don't have and don't need. I also think that we might sometimes overestimate our abilities to assess and monitor the risks. And yes, if you have a high level of conviction, power to you, and you're taking on a lot of idiosyncratic risks by allocating everything to just one company, and oftentimes many things are out of your control. Maybe in my defense of my own younger self, I know that the younger folks tend to work with a much more smaller capital size, and sometimes might think that, hey, diversifying is actually a waste of time. If I only have $10,000 to start off with, buying 10 different stocks means that I only put $1,000 in each stock, and they might not deliver the results you were expecting, at least on an absolute basis. Especially if you're right, 10x of $1,000 is only $10,000. But if you put all $10,000 into it, it could potentially turn into $100,000. Now, although I think that there's certain merits to this logic, but you don't know for sure whether your highest conviction pick will be the ultimate winner. And it's also important to train the muscle of appreciating diversification from the very start. Therefore, in my own reflection, my initial logic was to set a so-called ceiling in terms of how much absolute dollar amount I'm comfortable with investing into just one company. And once I hit that ceiling, I started investing fresh dollars to other names instead. And if to ask me, and I could start over again, I would say that a good rule of thumb is to at least have 8 to 10 stocks with equal allocations. And then allow your winners to run, and you should let the winners prove themselves, rather than making the discretionary decision to change the initial capital weightage of 50, 80, or even 100% going all in into it. So if it's truly a great company, the results and performance will show. But of course, don't be too hurried to cut the flowers and to water the weeds. Now, the third lesson. It's not just about diversification. It's about how you allocate, which I've learned in the later part of my investing journey. So it's really not about how many times you're right, but more so how much you make when you're right and how much you lose when you're wrong. And taking into account the thousands of investment decisions that Buffett has made himself, he said that his outperformance can only be credited to a dozen of those investment opportunities. Think about it. 2 investors can have the exact same stocks in the portfolio, but they can produce significantly different results. And the answer? Purely from allocation. So based on my own experience and listening to other investors share their journey, usually when you do your homework right and you don't just randomly buy trash stocks based on people's recommendation, you will tend to have 1 or even 2 superstar stocks out of 10, 2 bad picks, while the other 6 just give okay returns with varying degree. So I think newer investors might sometimes get a little bit too ahead of themselves and their own research and think that this opportunity they're talking about is the next best thing after sliced bread. But the truth of the matter is that the performance distribution tend to usually model after a bell curve. And sharing my own story of capital allocation, Meta has been one of the performing ones, alongside TSMC and arguably Tencent. But because I have a super outsized allocation to Alibaba, which is more than 30%, and at one point I was 100% into Baba, the results were much more muted compared to if I just allocated 10% flat to 10 different companies of my choice, considering that both Meta and TSM has more than doubled. So here's the rule. Have positions big enough that actually matter, but don't let that one stock dominate your entire portfolio, at least from an allocation perspective. Of course, for earlier viewers who have walked the journey with me, you might have noticed that I was still recovering from the PTSD Alibaba has inflicted on me, therefore resulting in my much more reserved averaging down approach when Meta had their 70% flash crash moment. But that's a story for another day. So after 6 years of investing, if I had to summarize, the biggest lessons: Have some exposure, even a small one, to broad base market index funds, diversify properly without being overconfident, and think deeply about your portfolio allocation. So I can't go back in time, but hopefully sharing my mistakes will help you build a better investing strategy from day one. So what's the biggest investing lesson you have learned so far? Drop it in the comments down below. And if you have found this video useful, don't forget to help smash the like button, and I'll see you guys in the next video. But more importantly, and hopefully, I'll see you guys on the moon. Goodbye.